Have you ever wondered why a successful company would choose to give away its hard-earned cash instead of reinvesting it for more growth? That it feels like a paradox. On one hand, a business exists to generate profits and expand compounding value for owners over time. On the other, many of the world's stalwarts regularly send cash payments to shareholders. Dividends go straight to owners' predictable, tangible cash. That choice appears to contradict internal compounding cash that could fund new factories, research, or acquisitions. So why not keep every euro and grow faster? Because the answer lives where finance, psychology, and corporate strategy intersect. Young high-growth firms typically reinvest every cent. Mature firms use payouts as a deliberate tool. Dividends solve for real human needs beyond a spreadsheet formula. To understand dividends, look at investor expectations and behaviors, not just balance sheets. The choice to retain earnings or distribute them shapes relationships, signals confidence, and imposes discipline. At its core, this is a human story: trust, habit, and the search for security. The puzzle deepens with buybacks, returning cash in a different way. Smart investors decode the why dividend, buyback, or both to navigate shareholder value. Why do some investors demand cash payments so consistently? Because different investors have different needs. Companies tailor dividend policy to attract a like-minded shareholder base, the clientele effect. Retirees and pensions rely on steady income. Reliable quarterly or annual dividends are necessities. They seek long, stable, and ideally growing payout histories. Consider Duke Energy, mature, predictable cash flows. A consistent dividend attracts income-focused investors, and these shareholders are less likely to sell in downturns, helping stabilize the share price. Similarly, in the US, Verizon's yield made it a favorite among income seekers, even as payouts adjusted over time. If it scrapped dividends to pursue growth, the shareholder base would rotate income out, growth in. Dividend policy is also marketing. It's a clear message about identity and the investor it serves. Consistency builds a long-term, stable ownership base. So for some companies, the dividend becomes part of the brand security and income as a promise. That symbiosis is the clientele effect at work. Is there a deeper, more psychological reason dividends feel so right to so many? Many investors struggle to sell shares for cash. They mentally separate principal from returns. Dividends feel like pure profit, safe to spend without guilt. Imagine a widow in Miami living on blue chip dividends. Her late husband's rule: never touch the principal. The quarterly checks are her allowance for everyday life. The fruit of the tree, not the trunk. If dividends stop and buybacks lift prices, her shares may grow, yet her cash flow vanishes unless she sells. Selling feels like breaking a promise. Liquidating the inheritance, dividends enforce self-control, providing a sustainable, guilt-free allowance. Even sophisticated institutions once spent only income dividends and interest reinvesting capital gains. Many moved to total return frameworks, but the old distinction shows how deep these habits run. For countless investors, dividends remain the psychologically safe source of cash. That's self-control, hardwired. What if a dividend matters less for cash and more for what it says? Actions can speak louder than press releases. A stable dividend signals confidence in earnings and cash flow. It's costly to fake. Weak firms can't sustain it. Procter & Gamble, with brand strength and robust profitability, has consistently paid and often raised its dividend. Investors read that as enduring strength. A cut, by contrast, screams trouble and can trigger sharp sell-offs. Initiating or raising a dividend is a long-term commitment, reputations on the line. Rising signals, optimism and strength. Stable signals, reliability and resilience. Cuts damage trust and confidence. Dividends are a crucial communication device between a company and its owners. Can dividends help investors keep management honest? Absolutely. Managers and shareholders don't always want the same things. Excess cash tempts empire building and prestige projects. That's waste, agency costs. A committed dividend pre-allocates cash to owners. Less slack forces, sharper decision making. Projects face tougher hurdles, or the dividend is at risk. In a mature industrial group, hefty dividends earmark surplus cash for shareholders. Big initiatives must earn outside funding. Add in scrutiny and accountability. That creates a virtuous cycle. The discipline, better capital allocation, fewer low-return ventures. A dividend isn't just a reward, it's a leash that lowers agency costs. Cash off the table, focus back on long-term wealth creation. Is there a structural reason to pay dividends? Yes, access to passive capital. Many mandates require dividend histories. A whole category targets dividend payers. Consider the S&P 500 dividend aristocrats, tracking long-standing US dividend raisers. Trackers must own the constituents' steady demand for included firms. Names like Coca-Cola and Procter & Gamble are staples across US dividend ETFs. Dividend commitment earns eligibility and long-term institutional shareholders. For many mature companies, the dividend is the ticket into a vast capital pool. No dividend, excluded demand, forfeited. Inclusion broadens the base, supports price, and can smooth volatility. It's strategic finance pay a dividend to access a very large segment of global capital. If dividends are so useful, why use buybacks? A buyback uses cash to repurchase shares in the market, also returning cash differently. Advantage 1, tax efficiency for many investors. Shareholders can defer and time taxes. Advantage 2, flexibility, no implicit promise like a dividend. Firms can increase, slow, or pause repurchases without drama. Advantage 3, fewer shares lift earnings per share. Higher EPS can make the stock more attractive and support price. Buybacks also signal belief in undervaluation and intrinsic worth. Dividends and buybacks often coexist. Maintain a steady dividend to serve income investors and signal stability. Use buybacks flexibly, especially when the stock looks discounted. Think of dividends as stability, income, commitment, and buybacks as flexibility, tax optimization, and valuation signaling. The smartest play matches finances, investor needs, and message.